Welcome everybody to week 33 of 2025. This is the Build Weekly Roundup. You've got Matt Dines here with me, Cameron Otsuka today, going through some headlines that we've seen over the past few weeks. We're glad to be back. We took a little bit of a break with vacations, had a little bit of some things that we're working on here with the internal to build that I'm excited about, but we'll need to wait for future episodes potentially to announce. So look out for announcements from our Twitter account as well as Matt's and mine. Um, Always good when you're building new things. I'll leave it at that for now. But to start us off here, we've got a really interesting set of advancements, I think, on several different topics. The first one being the China semiconductor trade. We've talked a lot about tariffs and kind of their impact on the U.S. economy, how we think that might play out over the long term as well. I think you're seeing some movement that I know Matt's going to want to be able to get into on the China front specifically. And then after that, we'll get into the IEA oil glut forecast. This one I actually told Matt before we got on today. I'm going to be asking him a lot of questions. I don't know the oil trade very deeply, so I'm going to be asking him, to explain this to me in basic terms. So hopefully that's helpful to the audience there. And then finally, we'll end with the PPI. If you didn't notice yesterday, PPI was definitely not what was forecasted. I think there's several factors that are leading into that, and I know Matt's gonna be able to explain kind of how that all ties into some of the political things that we've seen around BLS commissioners and things like that. So, without further ado, let's go ahead and get right into it. So, I'm gonna flip over to the presentation here. First slide: Trump draws backlash over deal to sell Nvidia export license. Maybe Matt, do you want to set the stage for what this is and why this is so, I guess, unprecedented? Maybe it's precedented. I don't know actually.
Yeah, so just to start off, we're in the dog days of summer. This is mid-August. Last kind of step, last time of the season, I guess, for people to get out, get their vacations in. And basically, we're just kind of laying on the stories and developments until everybody gets back for a Labor Day. I'm taking the market's perspective here. Once everybody's back after Labor Day, then they'll put their positions on for how they want to, go about strategically for the remainder of the calendar year. By that point, we'll be about two-thirds of the way through. So this is the home stretch that we're entering here. So no big market moves to report since the last time we spoke. I think you've generally seen a risk rally since Liberation Day. Bond yields have been somewhat volatile, not too bad, but trending down on the overall growth story and the economy, as well as the pressure coming from the jawboning that's involving the White House and the FOMC, which is gradually picking up kind of members in its coalition between Waller, Bowman, and probably soon to be others joining the chorus, chiming in for interest rate cuts on the horizon. So that's the situation we're walking in through. Expect those developments to pick up once everybody comes back from their vacations on, Labor Day weekend, and we officially start that closeout for 2025. But in the interim, we've had some major developments this week, Cameron, as you talked about. First one I'd go through is the semiconductor policy that came through the U.S. side. This isn't a deal as it relates to the U.S.-China negotiations that we've talked about in prior episodes. This is a kind of a supplement to the U.S. tariff policy. So what this represents, it applies to U.S. domiciled semiconductor producers, mainly focused on AI specific chips. So Nvidia and AMD being the key subjects of this policy. And what it amounts to is any chip exports or GPU exports from these US essentially covered manufacturers into the Chinese market will get hit with a 15% don't know if a tariff is the right word, but call it a revenue share, right?
The thought that came
And
to the
so
word that came to my mind when I first saw this was tribute, but
tribute, yeah, yep. So if you're a U.S. company and you want to maintain your U.S., rule of law, all of that, the legal groundwork that applies to your business and its formation, all of that. And if you want to export into the Chinese market, prior to this, policy, Trump had opened the semiconductor exports back up in July. That probably had something to do with the discussions that had taken place in Geneva and London in prior months. But basically, now we've added on a policy. Hey, if you're going to do it, you're going to owe us 15%. When we say unprecedented, what this reminds me of is if you go back and read the book, The Prize by Daniel Yergin, the history of the energy, oil and gas markets, which we'll talk about in a second, the latest update on the oil glut, as Cameron showed in that first slide. This kind of reminds me of the rush by sovereign powers to get their revenue share of the oil trade in the first third, if you will, of the 20th century. It's kind of once the energy industry was developed, hydrocarbon industry was developed in the US, that's where we saw Standard Oil build up. Um, at some point between like the 1910s, and this went all the way into World War II and beyond, you started to see the development of the oil industry in foreign countries as the suppliers started to go search out, not just oil production kind of reserves and deposits in the US, which were mainly in Pennsylvania and Texas. They started to realize, hey, there's probably other supply sources elsewhere. That's kind of what we've seen the semiconductors kind of expand to over the last 75 years as that industry has developed. It's not just the U.S. anymore, and our third generation suppliers. You'd think of like Intel coming out of Fairchild Semiconductor, all of that, everything since 1950. Essentially, the U.S. Suppliers and production has now been offshored, and that's where you see, the story of Taiwan
TSMC, yeah.
Semiconductor, really TSM, yeah, accelerating after the global financial crisis of 2008, right? They've just eaten everybody's lunch in terms of the chip fabricators. I think you're seeing that same story on supply expanding outside of the US. So, in this kind of context, the old energy majors, the first gen, Standard Oil, you had a couple others in the US, they export their production. And the version here was, hey, going after the major reserves that were being discovered in the Middle East and other places around the world. And it became a hot button issue for the sovereigns to get their share of the tax base of that oil and gas production, right? As you realize, there's consumption and economic activity taking place. What does the state naturally want to do? Well, it wants a piece of that. It wants to tax it to fund itself and the own growth of the state itself. So I think this is what you're kind of seeing here. The semiconductor trade is a growth. It is the growth industry, right? Or one of them, similar to what oil was from, Colonel Drake's first demonstration in Pennsylvania oil fields, right about, the Civil War era in the U.S. And then going into, I mean, oil and gas has been developing, on a growth curve ever since. I'd say semiconductors is kind of going through that same process, and it's reached the point where nation states are now kind of fighting over who's going to get their piece of the pie and get a tax, revenue share against the spoils from their own suppliers in the industry, if you will. So that whole process in oil and gas, as that industry globalized, was kind of in the World War I to World War II era. I think that's what we're going through right now with semiconductors in the information age. So big things are afoot. Now, what's interesting here is we don't have the article to put up on the screen here, but from the Chinese perspective on the demand side here, the actual market that would be supposedly importing the GPUs from Nvidia and AMD is actually policy kind of directive for Chinese industry to resist and not buy Nvidia produced GPUs. And I think this boils down to China would rather import its own semiconductor, chips all the way from design to fabrication. So it captures more of that value chain, and ultimately, its semiconductor corporations or domestic industry can be the world leader in this new competitive space. So this is like when we say unprecedented, it's unprecedented maybe in the semiconductor industry for where it's at in its growth curve and the global competition. But looking back to history, other key global industries, oil and gas among them, this kind of rhymes with and reminds me of what we saw in the resource grab in oil and gas reserves, and then import markets as well. Um, adjusting to that.
That's good
So that's
context because I think you
the
see
big
the
process we're living
yeah,
through.
you see
Yep.
the headlines, right? The unprecedented or never, something along those lines, and then you get into this and exactly what you explained there then. So that helps me understand, oh, it's actually not as unprecedented. Maybe specifically in the way that the deal is structured or something like that, but in terms of your sovereign nation wanting to take a cut of some type of business that's bringing in
Yep.
revenue, it seems like this is actually a pretty common situation.
Yep. Now, I think the second order effect, this is a reversal of the Biden policy that went into place, which was it was basically US and China head to head as adversaries, right? In terms of how the US viewed China. Policy under Biden, I think this was a 2022 executive
I think
order,
so, yeah.
was basically all exports were banned. All semiconductor exports were banned to China, or all AI specific, or the ones useful for cutting edge research and development, were essentially banned from China. It was basically to prevent, China as a civilization and society to outcompete the West on this AI, growth space. And I think if you're looking at this new policy adjustment to the US, now they're saying, hey, we actually want to be open for business to export to China. So I guess is there not that concern that they're going to, develop the in-house AI super capabilities that, might have been the fear in this great power competition? Or is it saying something under the hood? There's actually an openness for the U.S. to view China as, a cooperative partner in this new era under what are presumably going to be renegotiated terms to the original Kissinger era deal that was struck in the early 1970s. So
Yeah.
we'll know more as the future stories progress here. But I think what this actually is signaling is something deeper is underway and how the U.S. Um, views itself relative to China, what was once considered this great power competition and ultimately uh, headed for some sort of clash as far as, say the Taiwan situation, something like that. Well, maybe there is some alternative course. We're heading down some other road at this point, and if that were the case, something like this policy update um, might be a good indicator that we've taken an exit off of that other route towards some sort of U.S.-China uh, kinetic warfare type of matchup. So it's hopeful. I think it would be just broadly a negative outcome if the U.S. did ultimately arrive at that kind of kinetic war destination. This suggests there's you know, the trade and capital flows are going to be much more important, and whose domestic semiconductor industry ultimately wins out here is a key for how this thing develops. So we'll continue to wait and see, but I think this signals something much deeper going on beneath the surface in these trade discussions that we've basically been watching develop since the Liberation Day announcement.
Great. Yeah, and just to add, if people want to do some extra research on any of this, if you look up the Huawei Ascend chip, that's what Matt I think was alluding to. There's a lot of interesting things going on with China trying to incentivize its own companies to utilize certain chips, certain chip manufacturers. Look up DeepSeek, for example, and there's been some recent news around that as well. So yeah, continuing story. Let's move ahead here. So I have a lot of questions for Matt, frankly, on this headline. Oil glut to persist through 2026. For me, from my perspective, when I usually hear things like IEA cuts demand forecast, I first think of, well, that's a recession signal. So I'm really curious, Matt, what are you seeing with this demand forecast, and also, why was it so important for you to make sure it's one of our topics for today?
Okay, so IEA, just to set the backdrop, this is a kind of a non-government organization that was established in the 1970s oil energy shock turmoil that everybody is probably well aware of, or at least somewhat aware of. But it represents the demand side countries, so the European consumers of oil. US is in there as well, right? US flipped from an oil supplier to a net consumer, starting with the 60s and 70s. Didn't turn back into a net supplier until very modern times with the arrival of fracking technology in about 2000 era, but really adoption coming through in the 2010s. But this is essentially what this report is the outlook. When you hear OPEC on the supply side, everybody's familiar with that, responding to what they're going to do with productions. IEA, with its forecast, is saying is basically the consumers of oil, the demand side, saying this is where we think we'll buy, and ultimately, it's the consuming country that sets price, right? If you don't have any growth to sell into, um, the suppliers are, just you don't have a market. So it's key. It's important to mention this is just 33 countries. It doesn't have as broad penetration into some of the emerging markets, like let's say Africa, South America, et cetera. They might be in there, but it's basically your Western developed market countries who would be counted in. I think Japan's in it too, but it's basically your developed markets where they say their demand would be. I think another caveat, kind of piggybacking on the AI and semiconductors story, it's well known that there's going to need to be an energy and utilities build out to feed these data centers to continue the growth. That's presumed to be ahead of this upcoming kind of installation base, right? To just build out what server farms, training, facilities, just crank out AI models and all of that. Oil and gas is probably not the best solution. I'm not, a utilities expert, but what we see going through for the oil and gas industry, like your biggest consumer is going to be transportation, right? Like diesel on the industrial side for construction, development, moving semis and trailers, right, for goods moving down the freeways in the U.S. And then just say unleaded gasoline, all that stuff. Um, for just the rest of the auto fleet. But for AI, I think it's probably at this point kind of consensus. The energy demand for those, data centers isn't going to come from oil and gas, or largely from oil and gas. So what this is showing you from the consumption side is, the key things that oil is used for, right? Diesel, energy, all that, and then there's plastics and everything downstream. All of that is extremely soft demand, right? Maybe extremely is a bit too strong of a word, but basically we're going to be in a glut for, you know, 2026. That's through 2026. So that's essentially the next 15 to 18 months at a minimum. So what it tells you is the overall demand is going to be soft from the consumption perspective in these countries. Now, some stocks, some equities to look at in the U.S. I find this one interesting. TPL, Texas Pacific Land. This is essentially like it is an S&P 500 member. As of the last few years, it was added to the index. But if you look at performers in the equity market year to date, with all the developments we've seen, um, energy has been among the weakest performers across sectors. And this equity stands out to me. What it is, Texas Pacific Land Corporation, it essentially owns a lot of land and mineral rights to develop resources, mainly in Texas, but spanning kind of the U.S. I think they have some in Canada, or sorry, California as well. But they essentially what this company is they've got a decent amount of oil wells, natural gas, et cetera, in production that are actually delivering product to market right now. So there's actually sales and revenue taking place, but they have predominantly the balance sheet is captured in uh, uh, proven resources, but not developed. So there's no well on site or anything
They
like that.
know
It's
it's there,
basically like
just they need to
it's
actually tap it.
there. It's just hasn't been yeah, put into production. So it's basically sitting on the future resource in the ground, and as it becomes economically viable, and the demand is there, it'll be brought to market. And regulation allows for it. All of those things checked. It'll become the barrels delivered to market in the future. Now, if you look at this stock, like it is on an up and to the right trend and moving exponentially. And you can see that like when it runs up, it runs up and to the right and looks like a series of miniature blow off tops on top of a long running multi-decade blow off top. But so far this year, these, a barrel in the ground is what this equity is really kind of proxying. It's down almost 50% since the high, which was, in the euphoria on the November 2024 election result, where the Republicans had the triple sweep of Congress, Senate, White House, and supposedly positive outlook on the business, under that result. So far, it's been anything but. This has not been positive. Oil and gas have been among the weakest performers in this risk rally that we've seen since the immediate aftermath of Liberation Day. And the worst among them has been kind of the barrel in the ground has been the hardest hit. So this is kind of echoing like where the cycle is. Demand and growth within the economy in terms of like the old, what I would view as the old framework, call it like post World War II, oil driven growth, um, cars, clothes, houses, that type of stuff, the basic uh, developed market way of life, that's soft right now. And it's not being carried by your Mag 7, AI build out, where the growth actually is in the economy. So the IEA with their outlook report that just came out this week, forecasting the glut, it's signaling um, the weakness in top line growth in the broader economy, or the legacy economy, if you will. And the interest rates, bond markets, et cetera, are all kind of having to react to that at the same time. So top line growth, the actual consumption and expenditures in the economy. Expect that to, right now at least, the expectation is that this is a kind of a soft patch that the economy is working through.
Got it. Yeah, that helps me understand that too. It reminds me of kind of what you said a previous episode about looking at the signals from prior kind of regimes, right? So that copper to oil ratio is what you touched on last time, and I remember you kind of calling out that just because historically, the price action in copper signals a specific thing, you have to remember we're in this new world. Things are changing. Seems like there's like another instance of seeing that new world coming out. Uh,
It's the electrification trend is, part of that, right?
yep,
Yeah.
and
Copper
nuclear.
is the key component.
Yep,
Yep,
yeah,
exactly.
great. Okay, well then let's go ahead and push over to our next topic here, which is PPI. I don't know how else to explain what we just saw in terms of the PPI number. I think even for myself, we had seen the CPI kind of people's expectations and things, consumer sentiment numbers. It seemed like people were expecting to see a closer to zero, but still up, but closer to zero reading. But for producer prices, a big surprise. So walk us through what happened here, Matt.
Yep. Okay. So today's PPI numbers came in for some backstory. This is a Bureau of Labor and Statistics time series, which, if you recall, at the release of the July NFP number less than 2 weeks ago, on August 1, with the week and non-farm payrolls report, President Trump fired the head of the government's statistics and reporting agency. So this is in terms of data releases that they put out. This is one of their other key ones, but just important to note the backstory, just given the volatility, the results. Maybe some people inside of the deep Washington, D.C. bureaucracy want to see numbers go. These are numbers that are becoming more and more politicized, but that didn't start on August 1. I think there's always been an element of that baked into the process. But what it really shows is the consensus is breaking down in terms of how we can get the numbers to work for whichever side wants to develop the narrative and kind of point the ship towards the outcome they ultimately want to hit. But here's the background for July PPI. This was a huge call it a beat. They came in way hotter than expected. And when we say producer price index, it reflects the cost that the supply side of the economy is basically paying for the input goods or for the inputs that ultimately result in the goods and services that get sold to the consumption side of the market, which is households, business, government, who are the end consumers of those products. So here's the highlight of the number today. Came in at 0.9% month over month. The estimate was plus 0.2%. So it was a huge miss. So it's important to see to consider after that, what is the actual driver? The month over month of 0.9%, you can extrapolate that, multiply that by 12, and you see, hey, if we did this, if we actually continued and annualized that, that would be a totally unacceptable number. Now, doesn't mean that we're going to actually grow at that high single digits type of rate that would imply. But in terms of a single month's impulse, this data point is something that you don't just gloss over. You want to dive deeper and see what in the world is going on here. How could we get a reading that high? For the year over year number, it's 3.3%. That was in comparison to the street's forecasted estimate of plus 2.5%. So just on that 12-month look back versus last August, still missed it by about 80, came in hotter by 80 basis points. So very kind of informative things going on under the hood here. So next slide, Cameron. You see kind of the breakout chart that Bloomberg puts together. You've got the components broken out at, the first level down, so we can get a sense of where was this miss or where was this increase actually coming from. And I did this on the year over year basis, just because the month on month looks very spiky. But you kind of see the trend here. The PPI impulse ever since the 2021, 2022 surge. This was the transitory phase. Let's not go over that horse, which is now beaten to death. We've never what the portion of um, the uh, component, if you will, to that PPI or to the producer price index increases. That's not going away, and that's obviously been the clear driver. If you just look at this chart, is the kind of the teal colored bars represented by services, right? So what does that mean? Well, services is people doing something generally, right? It's a service you pay for, which isn't a physical thing, right? It's not a good is generally the framework here. So to really understand what's going on in services, why is services the sticky component that's causing these elevated CPIs, and then why did it surge in the July print and drive that 0.9% month on month? That's where you have to go into the breakdown within the services components and look at what's happening. And it's not just all one segment of services. Cameron, if you're at slide 7, this is a kind of a breakdown illustration of what a broker dealer sent me this morning on their analyst first assessment of the PPI results. If you look at like what's up, right? That second line, the green shaded bars, portfolio management services up and to the right, swinging from a -5 points or in excess of -5 percentage point contribution in terms of that particular type of service in the overall economy back in April on Liberation Day. And if you recall what was going on there, markets were selling off. Well, now in July, that number is the big swing, and you see that big green bar furthest to the right. That's portfolio management services, just a guy managing some funds. According to this data series, um, things like that, investments, data services, stuff like that, is a key driver of this PPI. It makes no sense relative to tariffs for this to be the first wave, but if you think about how trade like how these flows kind of propagate through society and actual costs increase in response to some sort of shock or event, starts first from the money center, right? The first assets to respond, if they're financial assets, right? And I have on slide 8 from a portfolio management standpoint, going back to 2002, the portfolio management services component of people really just proxies the S&P 500 index. So the first step on, say, cost rise in the economy, that's somewhat synonymous with saying prices are up or price levels are rising. If you look at services, they're the fastest to respond. Why is that? Well, goods trade, you have to move them, you have to work through supply chains, they're very complicated. Services, there's a lot of segments in here that are very hyper responsive. And if you think about a portfolio manager, right? If he's earning some like a fixed rate that's applied to the price of the S&P 500 index, the S&P 500 index, the information will flow fastest with the smallest amount of friction into those prices, which will carry portfolio management services higher as like the first to reflect. Now, for the next wave of services, if it hits goods, a new washing machine, things like that have to work their way through supply chains. you have a lot of purchase orders, a lot of transportation, a lot of steps in a manufacturing process for that to, fully work its way through. So if I'm a policymaker and I'm looking at this PPI report today, um, I'm gonna want to dive deep into this and understand what's going on. When I say that, I mean FOMC, um, Washington D.C., New York City, the key players who um, are responsible for the centralized management of the monetary system and the the trickling down into the from the financial economy into the real economy. This is where you do not want to make a mistake. So if this PPI index and hitting services first represents kind of the first wave of the shock kind of propagating everything we've seen since April. This is something I think you want to be very careful about. And if we get this decision wrong, uh, as far as whatever we do as far as monetary policy going forward, could have some pretty significant repercussions over the medium and long term. So, really important. Like stretch of the journey we're traversing here. It looks like heading into the September FOMC meeting, middle of the month, we're very likely to get that rate cut. That's been uh, very, very much so, and not hiding at all, pressured for from the executive branch of the federal government. This is one of those things where you might want to be careful what you wish for. We're in a spot where, as we mentioned, the energy market, as far as oil and gas, is signaling softness in terms of growth. It'll want that rate cut. The rate cut would potentially be welcome there. But in terms of the price level situation, whereas we've so far, 3 or 4 months in, um, the general response has been, look, no inflation. Um, we're good. We're in the clear. These things take time to play out. So this is one of those situations, and in my opinion, you want to be careful playing with matches. The best way is to leave them where they are. Don't give the don't be super aggressive or lack caution when there's a lot of kindling piled up that could materialize into a problem potentially down the road. Um, and I think that might be a good place to leave it. We're looking at maybe 2 to 3 more weeks of summer. Don't expect any major disruptions within markets, at least until we get back from Labor Day. But really, the story is set for some big developments to start taking place in September, which will then set the course for the remainder of the year.
Great. Well, thanks for going through all that, Matt. And so, like Matt said, we'll leave it there for the week. Make sure if you like today's episode to give us a little thumbs up on YouTube. I'm going to go through the whole thing, subscribe, all of that. You know the drill. Follow us on Twitter, etc. I do want to call out Matt is going to be speaking at Bitcoin Asia. So, Matt, I don't know if you want to maybe do a little shout out for where you'll be, when it'll be. I believe it's August 26th. Let me
That's
just make
right.
sure. Yeah.
August 26th through 28th in Hong Kong at the Convention Center on the harbor. So, any international viewers, especially in the Southeast Asian markets, part of the world which looks like the future of global economic growth, come out and see us at the Bitcoin conference in Asia. It will be a great conference, a lot of signal there.
Great. Well, thank you again, everybody, for tuning in, and see you all next week.
Thank you.